Welcome back. We got another week in review here. So, Quint, another very interesting week.
Yep.
We said we'd be back. So, what's going on this week in the markets?
Markets are down again. A difficult week in the markets across the board. I think second week in a row, the S&P closed lower. Yesterday, Thursday, was one of the worst Dow days we've seen all year long. And what's interesting about when we start to see these big moves, they make headlines, and they tend to extrapolate into more and more headlines, right? And because people get nervous, and it just perpetuates itself. Last week, we talked about the uncertainty, and then coming into the week, our concern was more of the same.
Right.
We got more of the same. And so, yeah, it's just been a difficult week. We have uncertainty is the key word, and markets are adaptive. Markets can deal with a lot of things. Think of how quickly we shifted and dealt with COVID. That blew so many people away that the markets rose when we were shutting businesses down. But what happened was money quickly moved into the areas that were going to benefit from staying at home, right? The Amazons, Googles, Microsoft, which led the market higher. What the market is struggling with right now is what's going to happen. Is there going to be a war? And every day it seems like we get different information. And then the market's struggling with what's going to happen with inflation and the Fed. So we don't just have
markets
one.
Do not like uncertainty.
That's right. So if we had certainty, I mean, literally, there's an old saying, the Rothschilds used to say, buy the cannons, sell the trumpets. And the rationale was that, again, we've said this before, that war is often good for markets. And one of the reasons is there's certainty. We're seeing a war play out. So my tendency is that if we get some certainty there, whether there's diplomacy or activity, markets will have a little bit of a respite. However, we're still dealing with the CPI, inflation, and a very aggressive Federal Reserve at this juncture.
Well, with all the things going on and all the uncertainty that's out there, I think it makes some people wonder, why do we not just go to cash and wait, like just completely go out?
Well, that makes sense, right? Somebody would go, well, if you've been concerned about the market as we have, why wouldn't you just take a massive step back and just get out and wait? Easier said than done, okay? And first of all, we'll say, and if you're a client of ours, you already know, because you got a notice, I'm sure, this week, that we had to sell something in portfolios, right? We had to reduce some further risk. I always hate to do that, per se, because I don't like trying to, quote, time the market. But we adhere to some pretty severe risk measures. And when certain levels are hit in some of our positions, history tells us that we have to take a step back. So right or wrong, we did that this week. We raised a little more cash, but not a tremendous amount. So the reason I say it's easier said than done is it's easy in hindsight to go, oh, get out and then just get back in.
Right.
Or you know, it's easy in foresight to try to do that. The problem is that markets move on the slightest hint of a change in the environment. What could that change be? So this is where people find it difficult to understand what could change the market. Well, while we're sitting here recording this, you could have a Fed governor or Powell or someone that comes out and says, you know, with the uncertainty in Russia, we're definitely not raising rates anytime soon. The market would react probably 5 to 7% in a matter of 2 to 3 sessions. Now, I'm just spitballing. That's how quick it would react. There's no question in my mind. So that's one area that could transpire, that things could happen. What if all of a sudden, you know, again, this is unlikely in my opinion, but what if all of a sudden there is diplomacy? Ukraine says, you know what? We're willing to sit down. We're willing to postpone our NATO alignment. I don't know. I mean, it seems unlikely, but, and all of a sudden, boom, market's up thousands of points. So the difficulty is, for anyone, I don't care whether you're managing hundreds of millions of dollars as we are, or you're managing your 401k on your own. The idea that you're going to be able to sell all and then, oh, by the way, just get back in the right amount of time is ludicrous. It very rarely happens. Historically, I have seen many people time one of those right, right? I've very rarely, if ever, seen anybody time two correct, meaning out and in. Why? Okay? Because if they're right, let's say that someone decides to just hit exit and get out, just go to cash right now. Okay. And they're right. And the market starts to decline. They will not get back in. Why? Because they're going to think to themselves psychologically, it's going to keep going. Ron Barron of the Barron Funds, one of the greatest investors of all time, had a segment. I put it actually on our Facebook, on our Joule Facebook page. I got my phone out one time and I recorded because I thought it was great. He was talking about this going into the last presidential election where people were like, let's just get out and wait. And his comment was very simply, let's say you're right. Let's say the market does crash, okay? And you're out. Well, you're not going to go, oh, I got that right. Now let's go ahead and buy. No, you're going to wait. And things are going to then start to improve in the market before they improve in the environment, and you're not going to get back in. So it's very, very difficult. That is why, Logan, at the end of the day, asset allocation, what's in stocks versus what's in bonds, is critical for clients. How much allocation do you have in a fixed income portfolio to buy yourself time during periods of uncertainty like we have right now? Diversification, owning things that just aren't correlated with the stock market. Again, we've had a great run. It's not always the case, but gold has been very favorable for us this year, and it's been helpful for the portfolios. So investments that don't always correlate with the markets will help, as well as having some cash. Again, not extraordinary amounts of cash, but some cash on the sidelines. The last caveat, and it's dangerous to do, but we do participate in this, is that at times we will say, you know what? The risk right here outweighs the reward. Let's trim a little. And we did that. We trimmed a little this week, leading into what could be, again, tumultuous weeks to come. I am in the camp, though, we are long overdue for a bounce, and it's coming. There's no question in my mind. But again, trying to time that, very, very difficult.
Yeah, overall, we have kind of the asset allocation, the diversification, and then time in the market versus just trying to time the market all the time. Now, trimming here and there makes sense a lot of the time, but taking full positions out and then full positions back in can be very difficult.
Markets are irrational, and they always have been and always will be. And often markets will move in advance of news. So, for example, and I just use COVID because it's the most recent example. As the market was moving higher, I didn't find anyone who was like, oh, that makes sense. It made sense only months down the road when you realized, oh, yeah, the NASDAQ is led by the largest tech companies, and they're benefiting tremendously. So, but in the moment when there's chaos and craziness, you're like, I'm not touching that. No way. So if you're out, if you just hit the eject button, again, you run the risk of just, sitting on the sidelines watching things improve. Now, again, how long can we be in this choppy environment? I have no idea. But ultimately, what I suspect will happen is things like dividends will become more important, which is why it's important, again, to have index exposure that produce dividends, et cetera, and just being patient. I mean, it's going to be some time, but I think, like all markets, this too shall pass.
Absolutely. Well, we want to keep it short and brief, but I first want to ask you, is there any updates on the partnership and the Blue Spring side?
Sure. So I've been talking about this and, doing the video and so forth. We're moving forward with this. We're in a legal review right now, which, holy cow, that's a lot. So no real big updates other than we continue to move forward. There will come a time, and I've had people ask, oh, if I'm traveling, how can I get this? We'll find you, we'll track you down, because at some point we're going to have our clients sign off. They have to consent to keeping us as their advisor, which we would hope all of our clients do that. And so we will look to email you that or mail that to you or something. I don't know. We'll figure that out. But no, things are moving forward. There's no real updates there. Very excited. I mean, I'm still very excited about the opportunity. Again, as we've mentioned numerous times, we're not going anywhere. The Joule name stays the same. I did have somebody says, well, if all that nothing changes, why are you doing that? So great question. I said, well, on our end, behind the scenes, Blue Spring will handle our human resources, a lot of our administrative tasks that we use and do every day, much of our operations. And again, those are the things for us that are going up considerably in price that we are now going to be saving on, and therefore won't have to be passing those on to clients, which means after 20 plus years, we will still remain charging our flat fee and not having to raise that in the future, which is fantastic.
Absolutely. All right, great. Anything else you want to add?
No, I think that, listen, markets are choppy. We're in a volatile situation. I suspect it remains very high emotionally, both through the ups and the downs. Charlie Munger recently spoke for the Daily Journal. If you are out there and you're interested in that sort of thing, 98 years old, one of the greatest. He's, if you don't know, the partner to Warren Buffett. Google that interview that he gave. Becky Quick did the interview from CNBC. It's an hour plus of great insight and history regarding the markets, and I highly encourage everybody to watch that. It's a bit colorful at times, too. But he can get away with that at 98 years old.
Absolutely.
All right. We'll catch you next week. Make it a great week.